Commodities. They're the raw materials of our global economy, from the energy that powers our homes to the metals that build our cities and the grains that feed our families. Commodities are everywhere. But how do they fit into a modern investment portfolio? In this episode of Julius Baer's How to Invest series, we explore the fundamentals of investing in commodities. Commodities are physical goods that are traded in bulk. They are real assets and they fall into four main categories. Energy, such as oil and natural gas. Metals, both precious ones like gold and silver and base metals like copper. Agricultural products, including wheat, corn and coffee. And finally, livestock. Unlike equities or bonds, commodities themselves do not generate income or cash flows. What do I mean? Well, stocks pay dividends, bonds pay interest, and real estate can generate income. Economically speaking, a bar of gold or a barrel of oil doesn't do anything. It just sits there. So why invest in them over other asset classes? Well, commodities like gold and oil can act as short-term hedges against inflation. As tangible assets, they often rise in value when inflation weakens fiat currencies, things like dollars, pounds, francs, etc. Gold especially tends to retain its value, though remember, commodity prices also depend on factors like supply, demand, and things like geopolitics. And commodities can also function as a diversifier. They often have low or negative correlation with traditional asset classes like equities and bonds, which means they can help reduce overall portfolio risk. And price movements can offer tactical opportunities. Some investors trade commodities to capitalize on short to medium term price movements. These can be driven by seasonal trends, weather patterns, or economic cycles. For example, wheat prices might increase following a drought because of reduced harvest yields and tighter supply. There are several ways to gain exposure to commodities. For most, an indirect exposure is most practical. Exchange-traded funds or ETFs that follow commodity futures, for example, are highly liquid, low cost, and easy to trade just like a stock. We'll talk about futures in just a moment. Meanwhile, mining company stocks offer potential for both dividends and capital growth, especially when commodity prices are strong. Of course, each route carries its own risk profile, and for a deep dive on gold and the pros and cons of funds, stocks and ETFs, just check out our previous episode. But first, let's get back to futures. This is the most direct route to investing in commodities, and they're agreements to buy or sell goods at a predetermined price and date. Let's look at a very basic example. Say you're an investor who believes the price of crude oil will rise in the next 3 months. Typically, you could buy a futures contract, say for 1,000 barrels of crude oil at today's price, which is, for example, $80 per barrel. If the oil price rises to $90 a barrel on the futures market by the contract's expiration, you sell the contract for a profit. But if the price of oil falls in that time, say to $70 a barrel, you incur a loss. Investors also have to consider cost of carry. This is the net expense of holding an asset over a period of time, including things like storage, insurance, and financing, minus any income it generates like dividends or interest. This type of investment is usually done by hedgers, producers, or consumers of commodities to lock in prices and reduce risk. Airlines, for instance, in our oil example. But traders and investors also use these contracts to profit from price changes without owning the physical commodity. Futures contracts are highly liquid and prices are publicly available and regulated, so there's good transparency. But be aware, investors who do not want to have the physical commodity have to close out their positions before the contract expires. Otherwise, you could be obligated to take delivery of 1,000 barrels of oil. Commodities are notoriously volatile. Prices can swing dramatically due to weather events, political instability, or shifts in global demand, and long-term returns can be uneven. Storage and logistics add complexity for physical commodities, and futures markets require expertise and active management. For institutional investors, commodities can be a strategic allocation. For individuals, they require careful consideration, clear objectives, and often professional guidance. but they remind us that investing isn't just about numbers, it's about understanding the forces that shape our world. From the energy transition to food security, they sit at the heart of our societies now and in the future. As with any investment, the key is clarity. Know your goals, understand the risks, and seek balance. Download Julius Baer's How to Invest guide in the link below to learn the basics of investing and how to build a balanced portfolio. Don't forget to like and subscribe to the channel to learn more about how to invest.